What are some tax tricks that you might want to use now to prepare better for not just this year, but for future years? We'll talk about that on the program, along with how to navigate rising interest rates. Certainly, interest rates have risen dramatically this year. What's the best way to try and approach that if you're seeing the impact of those higher interest rates? Welcome to the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, coming to you on a host of stations throughout the Central Florida region, along with one of the top 25 financial planning podcasts on the World Wide Web. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a cost-effective and successful financial plan. Speaking of this week, wow. Thanksgiving. Are you kidding me? How on earth did that happen? Hard to believe that. And what's interesting, I guess, is we will see on next Sunday on the program, I'm sure we'll be talking a little bit about consumer spending, because the day after Thanksgiving, Black Friday, is a big spending day and gives an early indication of perhaps what the consumer might be up to. That day after Thanksgiving isn't as big as it used to be in terms of significance because, of course, many of us do all of our shopping online anyway and avoid all of those stores. So certainly we'll be talking about that next week on the program. Interestingly, some of the data that came out this week in terms of consumer spending this past week showed a bit of an uptick in October. So there's some speculation that maybe people were out there shopping a little bit earlier and might have had some of those purchases, some of that consumer spending occurring earlier than the traditional months of November and into December. So time will tell on that. We'll certainly be talking a lot about that. Sadly, the Christmas season requires us to talk more about consumerism than ever before, but it's certainly a big part of the profitability of many companies this period of time or this time of year. So we'll be talking about that. Next Sunday won't be the end of November. We'll still be in November, Thanksgiving quite late this year. So you will still see us on our YouTube channel with a little bit of scruff. We continue to sort of honor No Shave November. That concept is intended to bring awareness to men's health issues, just like last month we celebrated a Pink Out Day at the Office for Women's Breast Cancer Awareness. It's November, so we've been doing this. I think this is the third year we've tried to do this. So basically gives an excuse for the guys in the office not to have to shave. So anyway, we're continuing with No Shave November. Fortunately, mine comes in, as I'm kind of inspecting it, comes in a little bit more gray than it used to these days, but such is life. Also this past week at the office, our annual food and toy drive kicked off. So we want to thank all the folks that have already contributed to that. Last year, we were able to donate almost 4,000 pounds of food to Second Harvest Food Bank of Central Florida. So we're excited to see if we can maybe match that or beat it this year. And then also collecting toys for Tots at the office. So all of that good stuff. Also this past week, we had our fourth quarter educational event. That one is a series of events that we do for our clients throughout the year, usually about one a quarter. And their educational opportunities. Had a good discussion. Actually kind of did it a little bit differently. Normally it's like a monologue, a single speaker. This time we kind of did it as a panel discussion between myself and our featured speakers. So it was positively received, sort of that change of format. And so we'll probably look to kind of incorporate that in some of our future educational events that we like to do for our clients. We usually do 3 dinners and 1 breakfast. This past week was the breakfast. So certainly some interesting opportunity to share good information about what's going on. In particular, I guess the headlines are, I think we can now officially call it that we do have divided government. It is always amazing to me how close this election that we just had actually came out. And I think it really does underscore the notion that we're probably as a country closer together, or at least certainly that more people sort of in the center, if you will, than the far left or the far right. It's interesting when you start to kind of look at how close a lot of these elections were, that I think that's a conclusion that maybe we're not as far apart as a country or as a society than the mainstream media would sort of like us to be. Also, another observation that I would make is that I think at the end of the day, the notion of divided government comes at a time where that's probably really important to have that. And the reason I say that is because there's some real work that the folks in Washington need to do. And they've gotten sidetracked, COVID this, politics this, that. There's some real work that needs to be done. So my hope that over the course of the next couple of years here, when we have this very closely divided government, that folks will come to the realization that they need to have conversations to engage in the real work. What's the real work I'm talking about? Well, I don't know about you, but I'm concerned about the debt. I think excessive spending doesn't work for anybody on a personal level, doesn't work for any business, and I question whether it really works for a government long term. So that's issue number one. If you break that down further, one of the programs that we all will be partaking in at some point in our life, good Lord willing, is Social Security. And so Social Security, as we all know, has a pretty significant projected shortfall over the course of the next several years. Well, that's the one you always hear about, right? Everybody talks about Social Security, projected shortfall. Oh, we may have to cut your check, and all those kinds of other highly speculative types of conversations. But the reality is, if they don't do anything, that ultimately could be an answer to how to solve a shortfall. What doesn't get discussed as much is the shortfall in Medicare, Medicaid. Over the same time period, the shortfall in Medicare and Medicaid is 7 times the shortfall in Social Security. So there's some real work that the folks in Washington need to do. So my hope with such an evenly, tightly divided Congress that folks will engage in a conversation, because you're going to need folks from the other side of the aisle to do anything with that narrow of a margin. Perhaps they'll actually get down to some real work, if you will, in terms of what needs to be done. That's certainly our hope as we wrap up our conversation about this most recent midterm elections. We're going to continue the conversation. When we come back, we're going to talk about the notion of these higher interest rates and how you might be able to impact them. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. One last comment on our conversation about midterm elections and some perspective on what's going on in Washington. I think it's important to also realize that the tax rates that we currently have and the estate tax exemptions and a host of other things are set to sunset at the end of the year 2025. And the reason that that's important is, even if this current group of Congress can't really come to any kind of an agreement, one thing for sure will happen if they don't come to an agreement is that your taxes are going to go up. All of these tax cuts that happened a few years back had sunset provisions. At the time, it seemed like, the sun is going to set on those so many years down the road. Well, guess what? That's rapidly approaching. There's only 3 more years where you're going to have these tax rates that exist today. 2023, 2024, and 2025. So if you're doing some tax planning or thinking about IRA conversions or any of that, know that those lower tax rates only apply for the next 3 years. All the folks in Washington have to do is sit on their hands, the very picture of what gridlock is, and ultimately your taxes are still going to go up. How much? Well, the 12% is going to go to 15%. The 22% is going to go to 25%, and the 24% tax rate is going to go to 28%. Those are not minor adjustments. Those are decent size adjustments. From a state tax perspective, which is a whole nother animal, the estate tax exemption for 2023, about $13 million. Guess what? 2026, it drops down to $5 million. So definitely some tax increases, major tax changes that are on the horizon that if we do get gridlock and nothing happens out of Washington, you're still going to wind up with higher taxes because of the sunsets on those particular tax provisions that were impacted and passed, I think, in the year 2020, if I remember correctly. So anyway, that's the latest on the thoughts on Washington. Welcome to the program. We're going to shift gears to talking a little bit about the impact that these federal rate hikes are having on people and how you might be able to sort of navigate around them. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're one of the top 25 financial planning podcasts on the World Wide Web. So if you haven't subscribed to us yet, well, why not? You should. At the end of the day, we're on every imaginable platform known to mankind. If you have any problems finding our channel on said platforms, including our YouTube channel, well, go to our website, Nelson Financial Planning. You can also type that in on those platforms because that should direct you to our channel. But if you can't find us, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar, and lo and behold, you will get connected to our channel on whatever the platform is of choice. My name, of course, Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So Fed keeps hiking rates, right? I mean, that seems readily what they're going to keep doing. Maybe only a 0.5% in terms of rate hikes going forward, but certainly a continuing upward trend in terms of those higher interest rates. So what do you need to look out for, and how best should you plan your future around that? So obviously with higher interest rates, the biggest impact is that you have the borrowing costs going higher. And where that is particularly important, or where it probably has the biggest impact, is with credit card debt. Credit card debt, as it is, already has a higher interest rate. And the reality is that's because it's unsecured debt. It doesn't have like a home behind it like your mortgage might or something like that, but it is unsecured debt. So that always carries with it a higher interest rate. And that interest rate pretty much goes in lockstep. Anytime the Federal Reserve raises rates, well, then you're going to see that credit card rate increase. The problem with that is that the total cumulative credit card balances in America today are approaching about $1 trillion, $916 billion to be exact. And that's before the holiday season coming up. The average annual percentage rate on these credit cards increased from about 17.3 at the start of the year. So it's pretty steep. If you think about that being the average interest rate on these cards, that's a pretty high rate. And now, since the start of the year, it's gone up almost a full 1.5%, all the way up to about 18.7 in terms of the average annual percentage rate on it. Average balance credit cards is about $5,200. So decent amount of money now, almost 20%. You do the math, that's $1,000 of interest in a calendar year. That's a whole lot of extra payment. So the thing you bought on sale isn't really on sale by the time you're done paying on it if it's on a credit card. To put that into perspective, if you pay just the minimum with that jump in interest rates, you're going to be having to pay for 3 more months beyond what you normally would have in order to get your balance off. So I think bottom line, pretty obvious there. The number one thing that you should be doing, particularly in a higher interest rate environment, is that if you have credit card debt, you need to make sure that you are eliminating that as quickly as possible. Item number 2, we alluded to it a little bit in terms of mortgage rates, home ownership. What do you do there? Higher rates mean that hundreds of dollars are getting added to the monthly payment. If we look at the average home price in America today, so $384,800 is the average home price in America today. If you put 20% down, which is kind of the traditional down payment that you would have on purchasing property, your principal and interest payment becomes $2,065. In comparison, that's about $750 more per month than if you had borrowed that same amount of money just 1 year ago when interest rates were just over 3%. So pretty dramatic. And in terms of the extra amount that you would need to pay on that average mortgage. So what can you do? Well, I think the bottom line is that you need to look at being creative. Maybe that means trying to put down a little bit more of a down payment. That would obviously reduce down the amount that you're going to have to borrow, reduce down correspondingly that payment. Number 2 is think about some of the things that we haven't heard in many years in terms of ARM rates. Now, ARM rates or adjustable rate mortgages, you haven't really heard any of that conversation over the course of the past many, many years because interest rates were so low. So there's no way you would do sort of an ARM rate because the expectation was eventually interest rates are going to go up. And what an ARM rate does is it has a low interest rate for a period of time, and then it resets to sort of the traditional, whatever the current rates are. Well, there's no really reason to explore that in the past when interest rates were low, but certainly today that might really be something on the table for you to explore if you are still out there trying to find a home. And then think selectively as well. As with anything, this is a major purchase, so make sure you are taking the time, doing the research, being diligent, because those costs of housing have certainly increased across the board. I think rents over the past 2 years have gone up 25% as well. So pretty significant. Now, there's a flip side of this. And the flip side is actually some decent news when you start to think about savings rates. So savings rates have gone up quite a bit within a short period of time, whether that's perhaps at your banks, it hasn't gone up quite as fast as you would expect, but in other places, particularly if you start to look at mutual fund money markets, which are different than a money market or a savings account at a bank, because that's going to be FDIC insured. Typical mutual fund money market doesn't come with that FDIC guarantee. But when you look at those, what you'll find is that some of the current yields are approaching 3.5% on some of these mutual fund money markets. So it may actually be a period of time where as those interest rates have gone higher, then you're finally getting paid some on your cash. So it may be a good time to maybe have some extra cash. Make sure you're getting a little bit more interest on it because certainly there's interest available out there. The downside to all of that is even if you're making 3.5% and inflation's at, say, 7%, you're still losing money on a inflation-adjusted basis. Anyway, we'll wrap this up and take a break and return after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. 7 weeks from today, just 7 weeks from today, it's January 1, 2023. Hard to believe that. 7 weeks from today, we are in a new year. What are some of the tax tricks that you can do between now and then to best position yourself for this year and into the future? Well, that's what we're going to be talking about on this segment of the program. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest-running radio programs, comes to you on a host of stations throughout the Central Florida region. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So make sure you subscribe to us on your favorite podcast channel of choice, along with our YouTube channel as well. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week, Thanksgiving week even, to help you change your life with a successful and cost-effective financial plan. So what are some of those tricks that you can do between now and the end of the year to not just improve your tax situation, but also for this year, but also perhaps lay the groundwork for greater tax efficiency in years to come? Well, the first one would start with taking a look at your investment portfolio, and particularly in this particular case, to really have a tax impact, you want to be looking at the after-tax, non-IRA, non-Roth, non-401k side of things. So with an after-tax account, that is money that you have put in, and ultimately, whatever the value is, that value is accessible at any point in time. And the only tax implications that you have on that, regardless of your age, is whether there's a gain or a loss. Well, because then you would have to pay taxes on the gain or on the loss. And here's the key concept. You would be able to use that as a write-off on your tax return. Well, I know this may be breaking news, but the year so far in the markets has not been particularly great. So one of the things that you may want to do, particularly on those after-tax accounts, is take a look and see, do I have any losses here? Is the value of this lower than the money that I put into it? Because the other thing that you want to probably take a look at is just make sure that the investments that you own, particularly if you own mutual funds, aren't generating or paying out a capital gain of any kind in the month of December. Now, that would be very rare to see that because of the performance in the market, but ultimately, to the extent any funds have sort of repositioned different holdings, then that could certainly have generated a gain that then gets passed proportionally on to all of the shareholders of that particular fund. So you could be looking at a situation where I lost money, I've got less than what I put in, and I'm about ready to then get hit with a capital gain during the month of December. At this point in the calendar, any of those fund companies, any of those investment managers certainly should be putting out approximate amounts of what those capital gain distributions should be. So it'd be easy to kind of find out that piece of information. And so you might want to shift out of that fund, avoid what could be a potential capital gain distribution, number one. But more importantly, you are able to then take that paper loss and convert it to a realized tax loss that you can use on your tax return to offset capital gains. Now, capital losses can be used to offset capital gains in their entirety. An extra $3,000 of those capital losses can also be used to offset other income, work income, for example. Beyond that, the losses, well, the good news is you don't lose them in a particular tax year if you don't use them. You get to carry them forward to future years. So just be aware that you can do that, and that may be a tax saving strategy that not only you could do for this year, that would certainly help, but also because you're able to carry those capital losses forward, then you're able to have that for future years as well. So certainly something to think about in terms of that investment portfolio, looking at the after-tax side of things. One caveat on that, you don't necessarily want to buy back into the same fund that you sold within a 30 calendar day period. Otherwise, it's treated as a wash sale and you don't get to take that loss as a write-off. So just be aware that there are some nuances there, but certainly something worth looking at in terms of your investment portfolio. And at the end of the day, is there a way to take those losses and generate them so that you'll have them on your tax return for this year? And to the extent that there are more, then you can carry them forward and help to reduce your taxes in future years as well. Number two, obviously this is a very popular activity between now and the end of the year. A lot of people do a lot of their charitable giving. Certainly that charitable giving winds up being potentially a tax deduction for this year. Now, a couple of things to remember. You were, for the previous 2 years, getting sort of above the line write-off on charitable contributions, $300 as a single person, $600 as a couple. That was an additional deduction for charitable giving that you were getting that you were eligible to take regardless of whether you were itemizing or not. Unfortunately, for the year 2022, that's gone away. So in order to have your charitable deductions or charitable contributions actually contribute to reducing down your tax bill, you have to look at itemizing your deductions. Well, with the standard deduction as high as it is, I think it's right around, what's it going to, $28,000 for a married couple, then you've got to get above that threshold in order to have your charitable contributions actually directly reduce your tax bill. So understand, charitable giving, it's certainly something that a lot of folks do as you get to the end of the year, but sometimes the tax implications can be quite limited. And in particular, this year, with the elimination of that extra ability to deduct a charitable deduction without having to itemize, those become more limited across the board. The reality is that there are some tricks to sort of maximize the tax efficiency on those charitable giving. One option is that if you do have an investment that has a gain, you could give the investment itself to the charity and then avoid the gain, but get the full value of that charitable gift as a write-off. Similarly, what you could also do is if it is a loss, like we were talking about earlier, you would sell that first, you get the loss on your personal return, and then give the resulting cash proceeds to the charity. So one of the things that we would sort of underscore there is make sure that you're looking at how to give to charity, to the extent you're doing that between now and the end of the year, in as tax efficient way as possible. One of the most tax efficient ways to do that is that if you are getting a required minimum distribution from your retirement account, don't forget about the qualified charitable distribution. Folks, this one is huge. We've been talking about it for years, ever since it first became an option for folks that are taking their required minimum distribution. If you have part of that required minimum distribution, or all of it, as much as you want, go directly to a charity. And there's the key concept. Don't give it to yourself first and then you write a check to the charity. It won't work that way. If you have that required minimum distribution go directly payable to the charity, then instead of having to claim your required minimum distribution, whatever the amount that you gave to charity, you don't have to claim as income, regardless of whether you are itemizing your deductions or not. So pretty powerful concept in terms of that qualified charitable distribution. And certainly those are the kinds of things that we see a lot of, particularly at the end of the year, people finishing up their required minimum distribution, also finishing up their charitable contributions. I'll tell you, that qualified charitable distribution really mirrors together very, very well to allow folks to be incredibly tax efficient. Likewise, we've got a few other things as well to talk about some tax moves that you can make between now and the end of the year that will help save you on your taxes this year and reduce potentially your tax liability going forward. The next one we're going to talk about after the break won't help you save this year, but will help you save in the future. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. On the program, we're talking about ways that you can potentially reduce your taxes this year and into the future. Certainly 7 weeks to go before we turn the calendar to January 1, 2023. there's enough time to make the most of some of these suggestions that we're talking about on the program today. So welcome in to Dollars and Cents. We're Central Florida's longest running radio program, also coming to you on a host of radio stations throughout the Central Florida region on the World Wide Web. Well, we happen to be one of the top 25 financial planning podcasts. So make sure you subscribe to us on your favorite podcast channel of choice, or you could also be a subscriber on our YouTube channel. Simply search for Nelson Financial Planning and you'll find us. If you can't, go to our website, nelsonfinancialplanning.com. Upper right-hand corner, a bunch of icons. Click on the one that looks most familiar, and you will get instantly connected. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning. So talking a little bit about some of the tax tricks that you can do, and they're not really tricks, they're all legitimate. The reality is that these are some tax moves that you can do between now and the end of the year to help save on your taxes and potentially save in the future. Well, this next one doesn't really save on your taxes for this year. That's the downside. But in future years, it certainly could make some sense, particularly in light of what we were talking about earlier in the program, where there are going to be higher tax rates in the year 2026. Why? Because with a divided government, you could probably expect gridlock. Hopefully not. Hopefully they get some real work done and help, particularly on things like Social Security, Medicare, Medicaid that needs some help in terms of improving the overall finances. But at the end of the day, if they do nothing, you're going to have higher tax rates in the year 2026. So you got 3 years of lower tax rates to maybe work through some strategies. One strategy that immediately comes to mind is the notion of converting an IRA over to a Roth. Now, there's a lot of caveats on this conversation, but I'm going to summarize those by saying be very careful when you do this, because what you are doing is electively deciding to pay income taxes that you would not otherwise have to pay. Okay? The other caveat is that this is income on your tax return. When you do a conversion, it is income on your tax return. What that means is that if you in the past maybe haven't had all of your Social Security being taxed, well, then guess what? This will trigger it. So you could have a layering up, if you will, of your tax liability. So be careful with that. Make sure you really kind of finely tune that projection to make sure that you are not dramatically jumping up your tax liability as you do these conversions. But certainly, when you think about a situation where you might be in the 12% income tax bracket, that's a great opportunity to say, okay, well, maybe I'll fill up that bracket, convert as much of that would still keep me at the 12% over to a Roth. And then in future years, when I take that money, then that comes to me tax-free. So ultimately, I wind up kind of saving taxes down the road. Remember, you've got to understand that tax cost and make sure that you're running it accurately. But that would be another sort of tax approach that you could do to help reduce future taxes. Doesn't work so much for this year's taxes, but certainly an option. Some of the other things to consider also, and depending upon how much control you have over this, certainly prepaying college expenses for next year into this year. Remember, when you're trying to get a tax credit for college expenses, the reality is that has to be money spent in the calendar year. And so if you're paying next year's bill in December, then you wind up getting that as a potential write-off, as a potential tax credit on your tax return in the current year. So that might be something to be thinking about, along with the fact of if you've got the potential to sort of defer income. Oftentimes, not a whole lot of people have this option, but if you're self-employed, things like that, you may have the option to sort of defer income into next year. The reality is, I think that's fine if you want to do that, but one caveat would be is that we do know what the tax rates are for the year 2022. I don't know what they're going to be for the year 2023. And I say that because you never know when Congress is going to change anything, right? We sort of know what they might be, but who knows? And so the reality is that the notion of deferring income into next year, some years that makes sense. I don't know if this is the year where that makes as much sense as it might have in the past. So anyway, those are just some thoughts in terms of sort of how you might be able to adjust things appropriately in order to generate out some better tax savings for you on your personal tax return, not only for this year, but also in future years. Speaking of future years, right around the corner, January of 2023, that means that you will all start to get, if you're on Social Security, a higher amount of Social Security. And here in probably another week or two, you actually should be getting a letter from Social Security, as they do each and every month, that gives you your updated amount. So make sure you keep an eye out for that because it really does reflect a pretty decent increase. As certainly we've talked on prior programs on this dollars and cents, the Social Security increase, the cost of living increase, is the highest it's been in like 40 years. So like 8.7% is a pretty significant increase. To put that into real dollars, let's say your Social Security is $2,000. Your Social Security in January is going to be $2,174. So pretty significant increase. Make sure you're looking out in your mailbox for that letter that you should be getting in the next week or two from Social Security that confirms what your new amount will be for 2023. Now, I guess that's the good news. Bad news is don't get too excited about it. It's an inflationary increase, which means that those dollars don't necessarily go further. They just kind of keep you even. That's the evil impact of inflation, is that it reduces your buying power over time. It's not actually more money in your pocket. And because of that, then, because it is, though, a higher amount of money, what you could certainly see is that you wind up paying more taxes on your Social Security, because those thresholds for paying taxes on your Social Security wind up being a stagnant, meaning that those thresholds for taxation of Social Security were set in 1984 and were never indexed for inflation. So as a single person, if you're above 25,000, couple above 32,000, you could very easily see your tax wind up being a much higher amount because you've triggered more of that Social Security to be taxable on your return. So just be aware of that, sort of a good news, bad news in terms of Social Security. So that's sort of the update. Look for that letter in the next couple of weeks from the folks at Social Security that updates that Social Security amount that you'll start getting in January. Well, that's it for this week's episode of Dollars and Cents with Joel Garris of Nelson Financial Planning. If you like what you heard or want to learn more, feel free to connect with one of our certified financial fiduciaries at Nelson Financial Planning. Just visit our website, nelsonfinancialplanning.com, or call the office 407-629-6477 to schedule a free conversation. Have a great rest of your Sunday.